So basically, the last few months has been pretty interesting because, as you guys probably know, I retired, and it's been very nice because not having to deal with the stress of work, it's just lifted like a big burden off my shoulders. And the important thing really is to make sure that I had enough money and I had the ability to continue to grow my portfolio and maintain my wealth uh, like over time, right? So one of the issues might have been like, well, the stock market has been going down this year. So did I retire at a bad time? Because if we look at the S&P 500 over the last year, ever since the beginning of this year, it's just been going down a lot. And my net worth has definitely taken a hit. However, it's part of it is about the wealth preservation of retirement, and the other part is really about cash flow. So one of the things I'm managing cash flow is I have some investment income, of course, from dividends and interest income. As well, I'm on the side just playing around with some options trading. As you know, if you've been watching my latest videos, that has been quite lucrative lately. And I find that as I move forward with learning more about options, the more fun it becomes. And also, the better I get at uh, predicting where prices might go and choosing the right risk to reward ratio for myself. So, one of the things I've learned in retirement really is, we talk about how human capital is an asset, and we talk about how the stock market and your portfolio is an asset. Real estate can also be an asset. My wife and I, we have uh, two rental properties, plus we're renting out the basement. But I think one of the biggest assets in retirement that is often overlooked is having flexibility, right? And that really comes down to knowing yourself, knowing your spending, and knowing your habits, and knowing what kind of uh, you know different risk tolerances you would be able to handle, and uh, what expenses are you not willing to compromise on, and which costs will you be like, well, if the markets are down, then I'm okay not taking vacation this year, or something like that. And just having that flexibility can really do a lot, because then you're not uh, going to run out of money in retirement, because you're going with the market, right? If the market is up, you're riding it up. And if it's going down, then you have some systems in place where you can kind of protect yourself on that downside. So it's all about being flexible. It's about being nimble and being able to change your mind. And I think that that goes a long way. What a lot of people do in retirement is, if they are sort of strapped for cash, instead of going back to um, work, they might take out like a home equity line of credit. They might take on a separate part-time job. They might take on like a side gig. They might sell options just very conservatively, because if you have a portfolio of, let's say, like $1 million, that's going to be maybe the situation for a lot of people. And let's say it's a dividend portfolio. So you have basically, let's say, $1 million in your portfolio. And this is giving you, if you're using the 4% rule and you have dividends, and you're also, let's say, 3% dividend yield, and you're also selling some stock. So overall, you're getting like a 4% um, yield that you can spend in retirement, right? This is a very common uh, rule of thumb. They call it the 4% rule. But let's say you're running a little bit short during some years. So what you can do is sell some very out of the money covered calls with your stock, which is a very conservative way to invest. And all you need is the current stock portfolio you have, which is the $1 million. And that can give you an additional 2%. So this could be like from dividends, and also from uh, capital appreciation, and the 2% would be from options, right? So then what happens is instead of a 4% return that you can spend, you can actually spend 6% sustainably over time. Now, how you would go about doing that, there are lots of different strategies of how to implement covered calls. But one of the best ways is to either do a bear call spread, which I'll explain in a little bit later, or you can just sell covered calls that are standard deviations away, which will give you like a 99% chance of them expiring out of the money. And that seems to be a pretty safe way to do it. I've seen other studies that people have done, and it seems to overall uh, give you a slight advantage over market returns over the long run. The only thing is you just have to keep track of it and continue to do it. So if you're doing monthlies, then every month you're setting up a set of covered calls, for example. Now you can combine that with, for example, some bull put spreads or just some put options on the other end, right? So there's different ways to do that, and that's what I'm kind of exploring right now with my own finances. Um, I right now don't have to do this, but it's nice to, have that choice available if I need to rely on options to uh, use as living expenses later. So I've posted a blog post before about what my living expenses are and what my household income is and all of that stuff. We're pretty much break even right now without the options income. So any additional stream of revenue I create from options trading, that's just extra. And I'm trying to be very uh, methodical about it. So I'm tracking everything that I'm doing. I'm writing down all of my trades, and I'm also preparing 1 week ahead what my next trades are going to be. So, for example, this is just literally like on a piece of paper. I was looking up different tickers that I might want to trade options on and just writing beside them what kind of strategies I might want to use. So like a BP is a bull put spread, and then SS is a short strangle. Uh, and doing this allows me to know once I implement the strategy if they worked or not, because then I can look back and say, oh yeah, I made money here, and this one actually lost me money. And when you do that throughout time, you create patterns, right? And then you notice which strategies actually work and which don't, and you have more confidence about that. Because if you only try a strategy once, like you try swing trading or day trading, and you just do it like a handful of times, it might work really well and you might lose money. But you don't know if the strategies that you've implemented will work over the long run unless you track it over a sustained period of time. And I think it's like that with anything you do with life and earning money, is you try out different things. Maybe you take on like 10 different side hustles. Maybe two of them work, and one of those two can create a substantial amount of money for you in the long run, and maybe even branch out and give you opportunities in other fields that you might not have thought of. So, one of the things that I've been thinking about lately is how much luck has played a part in my portfolio growth and financial situation. And I think it's hard to determine that because there's two different types of luck. Um, the first kind is just random luck, and I think that's the part that's hard to determine because you don't know how much of your success or failure was due to luck or bad luck. Like it's not very quantifiable because it's not very scientific. But the other kind you can actually control, and that's just stirring things up. So the more things you try, the more opportunities um, you'll have, and the more likely uh, money making uh, ideas will come to you. And other people who also want to make money, they'll be able to find you. You can collaborate. You can partner up. It's just like trying to find pearls in seashells, right? If you open up like one or two seashells, maybe you won't get that many pearls. But if you open up 100 or 1,000, eventually you're going to find some pearls. Uh, and I think that's what I've learned is the more you do and the more variation of different things that you try and take on, the more luck you have. I think there was a quote from, I forgot who said it, but it basically goes, the harder you work, the more luck you seem to have. And I think that's true uh, in lots of aspects, especially when it comes to finances. One of the questions, or I guess considerations that people have about retirement is they think about it in terms of the journey versus the destination, right? So some people might think, it's all about the journey, while other people think retirement is the destination. What you do along the journey doesn't really matter too much. So this is a quote from T.S. Eliot that I like, and he says that the journey, not the destination, matters. And to me, I think this is part of the story. What is true for myself is that it's actually a little bit of both, because the journey is important, because if the journey is not fun, then the destination is not really worth it. So it's definitely important to have a journey that you're comfortable, um, going in, so that you have the inspiration and the motivation to continue. But on the other hand, I mean, like, retirement is great. Like, I've only been retired for a few months, and so far it's probably been one of the best things that I've ever done. It's one of the best things I've probably experienced. There's just a lot more free time. I notice myself being more creative as well, because when you are stressed about, having a full-time job or just any kind of work in general, and when you are pressured to focus on something, your mind doesn't have the freedom to explore and to just relax. And, it's usually when you are in a quiet mode, when you're in a state of relaxation, that you have the best ideas, right? That's where the whole shower thoughts, um, you know, theme comes, because that's usually when you get a lot of creative thinking, is during those times where you don't have to be stressed out. So now that I'm not worried about like a full-time job, I have like all these other different ideas now, and I'm reading more and I'm spending more time with the family. So I recommend financial independence to anybody. Some people might poo-poo the idea. They might think, it's better to just find a job that you really like and then just work until you're 65 doing something you really like. I think that's a good idea as well, but I still much prefer having that free time of doing whatever you like, because if you are FI, you can still do the job that you really like, but in an instant, you can also choose not to. So uh, to me, being FI is still much better. And yeah, being retired, especially retired early, because then you have more time to spend with your friends and family. And we just added one new member to the family. So, because my wife just had our first baby, and it is a boy. So I'm going to see if I can pull up a picture of him here to show you guys. There he is. Yeah, so introducing baby Ace. He's about 2 months old right now. I don't know if you guys can see the resemblance. People say he has my eyes. Having a kid, a big life change, but I'm really glad that, going back to the whole retirement thing, I have so much more time to spend with him, and also with my wife. And it's just been really great so far. So I think the biggest benefit of retirement, and it doesn't matter if you're retiring like early or if you're 60 or 65 and you're retiring. Maybe this is kind of premature, but in my sense, the biggest advantage is you no longer have to give up anything today for a hypothetically better tomorrow, right? because when you're working and not retired, you're trying to save for a better tomorrow. Uh, you're trying your best to, look out for your future and to uh, save up money so that some kind of future that you'll have, you'll be in a better position. But if you're already retired, then you don't have to worry about that. You can do anything you want today. You can basically live in the moment because your future, you have confidence that that person in the future you, will already be taken care of because you're already retired. You don't have to save up for retirement anymore, right? So that's, I think, one of the biggest advantages, and I definitely feel that, and it's just a great feeling to know that I can basically live every day uh, in the moment, and I don't have to, destroy the moment uh, just to try to have a better hypothetical future that may or may not come. Because even if I save up like a lot of money, something out of left field can come along, whether it's with finances or health, or something happens to our house or anything like that. It's unknown, right? So really all we have is today. And then being retired just gives you that extra uh, realization and just confidence that things are going to work out. Uh, Yeah, Dawn is saying that this is a good time to be at home with the newborn. I think that's very true. I've heard other parents say that, the first 4 years of, uh, early childhood, it goes by really fast. And if you miss it, then it's gone forever, right? So that was one of the considerations I've had leading up to the uh, my retirement, is trying to save up as much money as I can in order to retire early so that I can, be at home when my first child comes along. So it's Yeah, so it's really all about that, like connecting with people and doing the things you like. So I really like this quote. I'm not sure who wrote this, but I think it's actually really true. The panda is asking the dragon, what's more important, the journey or the destination? And the tiny dragon is saying it's actually the company, right? So a little bit cheesy, but there is some truth in that, because if you don't have company, whether you're on a journey or whether you are at the destination, then it actually, it's not that fun, right? Because when you're going on a journey, it's definitely a lot better when you're with company. And once you reach the destination, uh, who are you going to spend it with? So for me, that's with my family, the people around me, and I think that it's going to be like that for a lot of people. Uh, there are people who believe that it's all about the journey and the destination is not really important. I would kind of push back a little bit on that, because the destination is very important since it gives you the direction that you need to go, right? It's kind of like a compass. You need to have fun with the journey. You need to plan out what you want to do, how you want to do it. Live life on your own terms. Don't listen to what other people say. So that's the journey part. The destination is just as important, because without a destination, um, then you're kind of rowing your boat back and forth and you're not really getting anywhere. So destination's kind of like a compass, points you in the right direction. Journey is how you're going to get there. And I think both are definitely very important for just having an overall fulfilling life, and especially when it comes to finances. If you don't have a plan, if you don't have some kind of strategic system to get to your destination, then that's going to be a problem. Of course, there's a lot of things you can't control, such as the stock market returns and what happens with the economy. But your own spending, your savings rate, your resourcefulness, um, your willpower, like how willing you are to get what you want, your reason to do it, like your why. Was it Nietzsche or someone who said, like, the person who has a strong enough why can bear any how? So that just comes down to sheer human will, right? And I've actually done some like just really quick math, and I figured out that uh, I could actually have retired sooner by like 5 years or so. Like basically in my early 30s if I had worked harder. But the thing is, then that wouldn't really be what I wanted in terms of like a balance. Okay, so what else did I want to talk about today? Yeah, seems like I'm not sure if I have a list of all the people here. Let me see if I can. Oh, participants. Okay, so I can see maybe who is here. Yeah, if you guys have any questions, just let me know in the chat. Um, Getting to a place of abundance and wealth, it's definitely recommended. And I would say the more exposed you are to other wealthy people, the easier it's going to be. One of the things that I was just looking at recently is this is Steve. He's on Twitter and I follow him. So he basically is asking this question using one word. What separates the rich from the poor? This is more like a mental idea, sort of like something that would be interesting to think about. Personally, I think if I had to pick one word, it would probably be attitude, right? Because like good luck happens to everybody, bad luck happens to everybody. Everybody gets disappointed with events. I don't think only people who are in the lowest, um, quartile of income gets disappointed. I think everybody gets disappointed, whether it's financially or otherwise. But what really separates the rich from the poor, um, at least from a high level perspective, I think, is attitude. And there's some really good answers here. I'm curious if you guys have any inputs into this, if you had to pick one word. This person's saying habits. I agree with that. Mindset, which is kind of like attitude. Doorman, that's a funny one, which is kind of true. Attitude, somebody already said it. Free time. Yeah, that's really important. And that's one of the other things that in retirement that people often overlook a little bit is they think about, oh, they're retired so they can just sit at home or sit on a beach, drink a cocktail. But it's really that free time that is valuable and not so much to just lying around not doing anything. And going back to my initial thought about the when you have a retirement nest egg, how much to save and about knowing yourself. Because what most people do is they have like a lot of money at retirement and they die with, so the majority of retirees die with more money than they started with at the beginning of retirement. That's like a stat from like the United States. All right, so this is like most people over here. And then uh, less than 50% of the people, or like less than a very small fraction of that, of the people, they die with like almost nothing. So what you want to do essentially is to have a balance between these two extremes, right? Where you're sort of in the middle, where you don't have like so much money that you're basically leaving it to, uh, like charity or your kids or whatever, because it's much better for your kids to uh, for you to teach your kids to make money on their own than to just give them a lot of money at the end of your life, because by then most likely they probably don't need it because they'll be retired as well. uh, but also, you want to spend your value, all the money that you've saved up during your life. So it's going to be like somewhere in the middle here is where you want to find that balance. And this is where being flexible comes in, right? So I talked about earlier one of the biggest assets that you can have is being flexible. So you have too much money in the beginning, you can spend more of it. If you don't have enough, maybe cut back on some expenses or find a way to make more money so that you're kind of straddling the two. And what is actually very critical for this to happen is you have to really know yourself super well. So I think self knowledge is sort of the beginning of all financial knowledge, because if you don't know yourself, then it's going to be hard to determine what is that right balance for you. Uh, Randy is saying optimism is another word that separates the rich and the poor. I definitely agree with that. I used to be a pessimist in high school. It didn't really turn out that well for me. And then I changed and became an optimist, and just a world of difference. Uh, Luck definitely had something to do with that, but I think primarily it's because of my change in attitude, switching from seeing the bad things in life to seeing the opportunities in life, right? Because uh, ultimately, you can't control the events that happen to you, but you can control how you react to them. So if you look at everything from a negative point of view, then you're going to find more negative points, whereas positivity can uh, be one of the most rewarding things long term. Uh, Education, yep, that's a good one. I actually agree with that because statistically, wealthier people are more educated. That's a correlation. Uh, I don't know if that's a causation, but it seems to you know hold water, right? Because the more knowledge you have, the more options you have, and the more choices you have, and the more opportunities you can get yourself into because of that, because you know things that other people don't. Savings, I mean, literally, that is the difference between people who have money and people who don't, is their savings. Uh, Frugality, consistency. Yep, so that ties in with habits and everything. Um, oh, sorry, I just realized it might be a little bit small on this stream. I'm gonna make it a little bit bigger in case some people might be using their phones, of course, to watch this stream. Mindset, so that kind of ties in with attitude a little bit. Another person said mindset, consistency and resilience. Yes, assets, health. Yeah, I mean that's a big one onto itself, right? All the wealth in the world doesn't matter if you don't have your health and if you don't have time. Uh, Sharon says resourcefulness. That's a great one. I recently did a blog post on that about all about like how to become more resourceful, and the basic idea is your entire income and your wealth is just a measure of your resourcefulness, right? So if you take somebody who is super resourceful, they will always have more money and more prosperity. Even if you take the richest people in the world and you take away all of their wealth, and you say you can't use your name or your contacts or anything, uh, go out and into the world and start afresh, they will all become rich very quickly, right away, right? Because they have resourcefulness. Another thought experiment, and this one's a little bit controversial, but I believe it to be true. If you were to take all of the world's wealth, like money, and you divide it equally between everybody, right? So everybody has the same amount of money, and then you just let the world continue to function, eventually all the money is going to get back into the original people's pockets. So the poor will continue to be poor, and then all the money will flow back into the people that were rich before, right? So the difference between them is really just resourcefulness, because people who have, like the people who are self-made, obviously, if you get an inheritance, it doesn't prove your resourcefulness. But if you are self-made, you that's the biggest asset that you have is resourcefulness, right? Which is your human capital, um, and you can transfer that to any part of the world. You can place Mark Zuckerberg in any English-speaking country, and he's going to be like a millionaire very quickly, because he's super smart about computers, and then he has uh, the resourcefulness that a lot of people don't. So that's definitely something that I agree with. A lot of people saying mindset, self-control. Yep, self-control, willpower, that definitely counts. Habits, action. Yeah, it can't just all be theory. Like you can read 100 books, but you're going to be nowhere close to getting more wealthy if you don't take any action. Um, this one's interesting. I actually read this before, so I wanted to cover it because a lot of people like this one. You can see 84 likes. Wendy is saying privilege, right? So every person, this is what she believes, has had the privilege which the poor did not have in the forms of either knowledge or capital, education, networks, mentorship, support, etc., etc. And then Shantae comes with a rebuttal and says that actually privilege is just an excuse because many rich people were actually poor. So how is it that some people who are poor become rich and others don't? Right? And maybe privilege is something that is granted to everybody in different at different times, at different intervals, and in different amounts. And then so other people are chiming in here. Right. So Cash is replying to Wendy, right? Because Wendy is saying privilege, and then so Cash is saying, for the most part, that's incorrect. Because if you're in America, or let's just say by extension Canada as well, everyone has a chance here. And for the most part, I would agree. But if you were born in India to a class society, then you could make that claim that it's about privilege because it is very hard in certain parts of the country to gain privilege. But I think in first world countries, in developed countries, the idea of privilege is not as strong as an argument as in other parts of the world. Um, and I think one of the misconceptions is in order for somebody to, like rise up the ranks of wealth, they have to have privilege that is equal with everybody. So they have to have the same privilege in terms of what Wendy was saying about capital, knowledge, education, networks, and all of that stuff. But I think it's more nuanced than that because, first of all, education, what type of education, right? Like, uh, at first glance, maybe a lot of people will think what she means by this is a formal education, like going to university. A lot of people don't have the finances to, and they can't get student loans to get an education at college. But that's only one way to think about it, right? Because I think it was Jim Rohn who said, formal education will make you a living, but self-education will make you a fortune. So if you want to get rich, uh, it's much better to self-educate. And with the technology we have now, I mean, this is such a low barrier. You can self-educate yourself in anything. There are free courses online. There are communities online, including FinTwit or Finance Twitter, which I'm a part of. Just like this is one example that I'm sharing here, where people just like share ideas about like how to make money, uh, and just other ideas about investing and money. So I don't know, it's quite interesting. Sometimes there are some drama on Twitter, but it's just a really cool place to get different interesting ideas. Personally, I think Wendy has a really good point. It is about privilege in a lot of cases, but I also think Shantae is right as well in that, look, it is about privilege, but you know, everybody has some kind of privilege one way or another. And this kind of brings in what Randy was saying about like optimism and my sense about like attitude and mindset and all of that stuff comes in as well. One of these tweets you can do something about. The other one you can't, right? So if you think privilege is what separates the rich and the poor, you can't do anything about that because if you don't have an education, if you don't have money to go to school, then you don't have money to go to school. If you don't know like Bill Gates or Warren Buffett, then you don't know them. If you don't have mentors, you don't have them. Uh, if you're living in a family where like nobody went to college before and you don't have support, then you don't have support. But what can you do, right? And this is where, like, if you turn the privilege into an excuse, then you can think about, okay, So I don't have those privileges, but what can I do to increase my chances of getting more privilege? And I think this is what Shantae and other people are kind of addressing, is this overall idea of don't focus on the things you can't control. Instead, look for opportunities where you do have control over your life, right? So go out and look for people online. Look for communities where people have shared thoughts, shared ideas, and mentalities about certain topics, like finance or investing or stocks specifically, anything like that. And what you'll find is that you're going to learn so much through other people helping each other. It could be forums, it could be like clubs, it could be um, uh, different IMs or chat. It could be on Discord, just whatever communities are out there, and it's all free basically. Through those, you should be able to find a lot of the things that you're looking for and being able to connect with people, and that's going to get you networks, right? That's going to uh, put you in a place where you can find mentorship, right? And that's going to give you the support of the community that is supporting you doing anything that you want to achieve with that particular topic, whether it's money or engineering, robotics, what other kind of ideal that you want to see yourself doing. And that's how you gain knowledge, right? Like knowledge isn't something that somebody teaches, it's something you have to learn, right? So you can't teach knowledge to uh, a student. The student has to learn the knowledge himself. And then through knowing people, that's how you get capital, right? Because just talking with like the people I've met on the internet through finance Twitter and through my blog and through YouTube, we are having discussions about like how do we pool our money together to make this investment here or to buy that property there. And these are just ideas, but it opens up opportunity to capital, right? Because then you can uh, basically pool money together and almost crowdfund something that you can't do alone. So all of these things are in your control as long as you don't make privilege an excuse. Yeah, so that's pretty much what I have for like retirement. Took a bit longer than I thought. I'll just quickly, unless there's any questions here or if there's any topics that you guys want me to cover, but I just wanted to quickly go over what I think the stock market is likely going to do over the next couple of weeks. And then, like I mentioned earlier, I wanted to show a uh, strategy using options that might be useful for some people who already own stocks, but they want to make a little bit of money off of that. Okay, so Mohammed El Arian used to be the CEO of PIMCO, very smart guy, very popular guy in the finance world. So he's sharing this. This is on Twitter as well. He's sharing this chart where it looks like there is a lot of short in the futures market right now. If you look at the short interest, this is 2022, so this is starting from about last month. And what this means is there's a lot of people who are thinking that the stock market is going to go lower, at least over the next little while. And if you look at the trends, just using the S&P 500 as an example, if I turn on some indicators here with the moving average, let's go with because if we're just looking short term, then let's go with a 5 and let's go with a 7. So just make this a different color. So you can see for the most part, the purple line, which is the 5-day moving average, which is shorter, it's above the orange line, which is what you want if you're bullish. You want the stock market to go up. But you can see we've crossed it last week, right? And then we've just been continuing to go down since, which means short term, we are likely to see another pullback. Actually, this looks very much similar to this point back in March, April, where the stock market went up and then a very sharp turnaround. So it looks like we're seeing a similar situation there. I don't see a lot of support right here. So I think we're going back down to around the 3,700 level. We might pause a little bit here, but even there, that's not a really strong support. So I had said before that I thought June was the lowest at least for this year, it looks like we might. It looks like we're actually going to be going back and testing that low. So there's a chance we could go through it, depending on economic data. But for the next couple of weeks, I definitely think that the stock market is heading lower. Now, long term, that doesn't really mean anything because 10 years from now, when the S&P 500 is at like 10,000 or 15,000, uh, it doesn't really matter if in 1 or 2 weeks it drops or goes up by a couple hundred points here or there. So if you're a long-term investor, which I assume all of you are, then do not sell right now, even though I'm saying the market is probably going to drop lower. You can have hedges in place instead if you want to capture a little bit of the potential downside. And I'm going to show how to do that in a couple minutes here with the bear call spread. But otherwise, just continue holding on. If you have dividend stocks, those will continue to pay you. And remember, when you're buying a stock, it's the company that you're buying, and maybe there's going to have like 1 or 2 quarters of negative growth or some lackluster financials. But as long as you pick the right company, then when we look back at this time a year from now, like if I make another uh, video in August of 2023, this is most likely going to be it's going to look like a very good point to get in, like a very cheap price for stocks. In terms of if you're buying stocks right now, where are some good places to look at? So I have this, I've been looking at this resource for a while. This guy, Yardeni, he makes these research papers pretty much on a daily basis. And what I've noticed is that if we look at the S&P 500 stocks for the small cap stocks, which is over here. Okay, so we have the forward PE ratios, right, for the S&P 500, and this is for the S&P 600 small cap. So it's basically broken up into 3 different charts here. The first one is the most popular S&P 500. You can see the PE ratio, which is a measurement of how expensive the stock market is. For the S&P 500, which are the 500 largest companies publicly traded in the US, it's not really that cheap right now. We're at about looks like 16, 17, so 17.8. So it's not particularly cheap compared to historical averages. For mid cap, it's looking better, right? We're at 12.9. And you can see historically it's hovered around the 16 level. But for small caps, we're pretty much down here to some of the lowest points in history. And this goes back over like 20 years. So if I were to gamble and say, like, if I could only buy one ETF or one stock, which one would I go for? And I can only hold it long term. I probably choose like a small cap ETF to try to capture some of the S&P 500 or 600 small caps because valuation wise, we're at the lowest point in decades, in like multiple decades. Like the last time this was down here was in 2008 during the great financial crisis, right? Because even the 2020 blip where it just dropped and immediately shot back up, that was higher than what happened this time around. Like in June, we definitely fell below that. So in terms of like what particular stock or ETF you can buy for that, there's lots of different exchange traded funds that captures small caps. The Russell 2000 is probably the most popular. So I think there's an iShares one, IWF, but Vanguard makes them as well. So, or sorry, IWM. So here's the Russell 2000, and there's a lot of small cap stocks in here as well. Anyway, I just wanted to share that. I don't have this one myself, but it's something I'm looking at getting into. If I do like if I sell puts on something like this, and I'll try to pick it up at a lower price, right? But I think over time, the people who buy small caps or IWM at this level, um, they are going to be well rewarded over the next, say, 2 or 3 years. And that's just a high probability, right? Because nothing is certain in investing. It's just looking at the chart, looking at the uh, historical valuations. That's sort of what I'm reading it from. Okay, so but in the short term, going back to my option strategy, what can you do if you think that the stock market is going to continue down over the next couple of weeks? So what I think is going to happen is probably something, just going back to the historical trend. It looks like we're going to do something, yeah, something like this. So maybe even going past that June level, although it's hard to say right now. But at least we're going to hit maybe like this part right here around 3,800. So if that's sort of my thinking behind it, how do I want to play that without selling any of my stocks? So one way is to do a bear, or sorry, yeah, a bear call spread. And what that basically means is having a call option, but also with protection. So uh, let's say, so this will be the bear call spread option. So if you're not familiar with options, this will kind of give you a taste of what you can do. And if you already know options, then this is one strategy that I'm already using to great effect over the last couple of weeks, and I'll probably continue using this. And because the stock market has, it's been going down last week, it's actually so far has been working really well. So let's say a stock is at $100 right now, and we think that the stock is going to drop, right? Or it's going to go up a little bit, but not too much. So what we can do is, let's say, sell a call option with a strike price of 110, and that basically means if the stock goes, either straight or it goes up a little bit or down, then we basically make the premium and the option expires worthless and nothing happens. But what if, for some reason, the stock were to shoot up really high and it goes to like $120, right? And it reaches this point. Well, now we're kind of screwed because we have to sell our basically we have to sell the stock for $110 because when we sell a call option, we're giving somebody the right to buy it from us at $110. So if the stock goes up to 120, which is not what we want, then we're basically selling the stock to somebody for 110. But because the stock is now at 120, we have to buy it at the market rate. So we have to buy it at 120. This is not good, right? Because we're in the hole $10. We buy it high and then we sell it low. That's not what we want to do because then we're losing money. It's actually we're losing $1,000 because you have to times 100 shares per contract. So that's kind of risky. What a bear call spread will do is we think that the stock will continue to go down. So the thesis is still the same. We think this is going to be a bear market, and we're doing a call here, and we're also doing a spread. So what a spread is just two options with a difference in price in the middle. And there's different ways to do spreads, but in this case, we're doing a price spread instead of, say, like a calendar spread. So what a spread basically means is instead of, let's move this 122 up here. Everything stays the same with a bear call spread. The only thing is that we buy another call at a strike price that's just a little bit higher than the one we sold at. So let's say we buy the 112. Okay, so the 112 would be like somewhere over here. The 110 is like somewhere over here. So if the stock goes in the way that we don't want it to, and it goes up to 120, we don't lose $1,000, right? Because we bought the call at 112, we own this option at that strike price, which means we have the right to buy it from somebody else at $112. So even though we still have to sell 100 shares to somebody for 110, we don't have to buy it at 120 anymore, right? We can buy it at 112 because we can exercise our call option that we own, right? So this is why you buy that one. So then instead of losing like $1,000 maximum, you would lose at maximum $200. Now you don't get as much premium as just making the selling the call option at 110, because when you buy a call option, obviously you're paying money for that. But because the 110 option is more expensive because it's closer to in the money than the 112, you sell it for more money than you buy the 112 at. So that's why you like make the spread, right? So it's a bear call spread. So that's something that you can add into your option strategy if you want to do something like that. And if you haven't done this before, I would recommend to do that on an ETF like the Triple Q or the Spider SPY ETF, which tracks the S&P 500. So that could be a strategy that might be beneficial, especially if you think that the stock market is either going flat or it's going down. And the other thing that I haven't really talked about, because it's kind of up to you, is duration. What I'm doing right now is weekly options, and that's been working fairly well. The problem is if you don't have the time to do this, then you can't do this. This is a very time, this takes a lot of time. So I'll just show you an example of the trades I've done in August. So this is all on my website. You can take a look at this if you want. But you can see on the first week of August, I made like a couple of dozen trades here. And I've chosen really short durations for the most part. So under the initial, sorry, where is it? Initial days to expiry. So when I traded these options, this was how many days left until the options expired. Just like 1 day, 2 days, 7 days, that's like a week out, right? 4 days, 11 days, 4 days, 3 days, right? Because when I'm doing some of these options on like a Wednesday, maybe they expire on a Friday, so that's only 2 days away. But so the advantage of this, like why would I want to spend all this time doing this when I can just sell monthly option, is because you make you make quite a lot more money doing that. As you can see, I started weekly options in August. I actually started in July, but most of my options in August were weeklies. So you do have the advantage of getting more premiums on a per time unit basis, right? So in other words, if you sell an option that is 30 days away, maybe you'll make $100. But if you sell an option that's 7 days away, then you'll make like $40, right? So that's just an example, but you can see how 3 or 4 7-day options will add up to more than one longer 28-day or 30-day option. And the other reason I like doing this is I can control risk better that way, because it's much easier to determine how much the price will move over the next week compared to the next month. And then just one last tip that I want to just throw out there if you're doing options in terms of risk management is sell your losses as soon as they become losses, or like have some kind of stop limit. So if you have an option that you expect to make, let's say $100, and it goes against you like by $50, sell that right then, because I think I did a video last week on what happens if you don't sell an option if it goes against you. I think it was with C Limited. So instead of making like $60, I could have lost $300 if I left it and didn't close it. So that's definitely one of the risks you have to look out for. Yeah, so I think that's pretty much what I wanted to cover today. Was there any other topics that you guys wanted to talk about? Um, I guess just touching on real estate really quickly, both in Canada and the US. I don't know if you guys are watching this from uh, what location, but yeah, it doesn't really matter where you are. I think real estate is gonna uh, drop in price. So if you're thinking about getting into the market, I would wait until maybe like at least the end of this year, if not 2023. I think that's when prices might bottom because right now the trend is definitely going lower. Just across Canada, for example, prices are year to year down 5%. So in my last live stream, I think I mentioned based on the rate of interest rate increases the Bank of Canada was doing, we'll probably see like a 5 to 10% um, price reduction this year. It looks like they're increasing rates by more than I thought. So now I think in larger cities like Toronto and Vancouver, you're probably going to see maybe like a 10 to 15% correction in terms of prices. Sales is a different story. Sales, it's down like 30, 40%, maybe even more. Yeah, so Don, if you just look at the Toronto landscape, I'm sure you've seen as well sales coming down and prices are going to follow pretty soon if they haven't already. So if real estate is one of those things where I'm not comfortable shorting, um, but if you're looking to invest in real estate, which is I think always a good idea. I started in real estate. It was one of the biggest contributors to earning my first $1 million in net worth is real estate, and I think that goes with a lot of other investors as well. Because it's something tangible, it's something you can learn about, right? Because stocks is kind of it's a little bit of theory with options. There's a lot of math involved, and but with real estate, it's like there's a house, like there's the rent you can get for it. Like you can cut the grass, you can fix up the roof, you can do this to it, and so it's maybe a little bit more tangible and practical and easier to understand. So unless you're like super against real estate, which I understand, then um, I would definitely consider that. Cameron's asking, what is my average margin interest rate? I believe it's around 4% right now. Let me just double check. Usually they have it on the website of Interactive Brokers. So as you guys know, I have two different accounts. I have a Canadian account and I have a US account. So right now, if we look at what my cash situation is. So Canadian, I am negative 19,000 cash. US, I am negative 90,000. So this is how much I owe my brokerage right now. And for the US interest rate, I'm paying 3.83 right now. And for Canadian account, I'm paying 3.9. So about the same, a little bit more for Canadian uh, currency, but about the same. Have I looked at SPGI? No, I have not. Let's take a look at what that is. I might have heard of it. I just don't know the symbol. Oh, it's S&P. Okay. Yes, I have heard of this. I just forgot what the ticker was, what the ticker represented. It, from what I can tell, it's actually a pretty good company. The only thing is, it's just a little bit stretched in terms of valuation. So this is the company that actually like runs um, the S&P committee that kind of has their hands in a lot of different indexes and the stock market. I'm going to take a look at Fundamentals Explorer and just see what I can gather from this. Just some really initial research because I haven't looked at this company in a while. Let's see what TipRanks has to say. Strong buy with a 407 target price target. Okay, so that's a 12% upside. That's not bad. What I like to do is rank by, I'm sorry, I can't make this much bigger than it is. So I'll just kind of explain if you can't read what these small texts are saying. So I'm ranking by the number of stars of these analysts, and I'm just looking at the top, like the top three, which are the 5 stars. And it looks like it ranges from 385 to 500, right? Because like, who cares about what this person says? They're not very credible in terms of um, their ratings in the past, which is why they got lower start rank. Okay, so 11 or 13% upside. Let's look at some key ratios. And the reason that upside is important, like you can't just look at if a company is a strong buy or a buy, because there are different levels of strong buys and buys. Because what if one company has, like in this case, an 11% upside based on the average price target, but another similar company has like a 15% upside, right? So that's what you want to take a look at. I'm looking at the PE ratio, and it looks like we're right sort of in the middle of what it was in the last 5 years. So this is what I mean by the valuation is a little bit, high. It's a little bit higher than what I would like to buy it at, because the 5-year average is 28, and we're pretty much right there right now. But that's PE. Let's take a look at cash flow as well, because that is also important, price to cash flow. And it looks about the same. Actually, I think we're a little bit higher currently than the 5-year average. If the stock market drops by another 5 or 10%, and um, S&P Global drops by 10 or 15%, then the PE ratio would go down to like 24 or 25. That would be more of a reasonable investment, I guess, right? So it's not a bad investment if you buy it now, and it's a good company. It's just there are better opportunities out there. But thanks for mentioning that. I haven't looked at this stock in a while. Cameron asks, what is your strategy with using margin? That's a good question. Let me bring up my drawing board here again. Okay, so the way I use margin is kind of like a two-tiered system where I use my margin mainly to buy stocks, and I try to keep my margin, my excess liquidity to usually around 50K to like 150K. Now, when I use options, this can change a lot. Sometimes I'm down to like 20K if it's the last day of expiration, if it's like a Friday, and sometimes I'll have like 200K of excess liquidity if I'm thinking about using a lot of options that week, because options require a lot of capital. But I mean, that's why they potentially can make a lot of money, is because they do use capital. If you have $100,000 of capital, like say an account, not using margin, it's reasonable to expect with somebody with way more experience than myself that they can generate something like 15K a year in option premiums safely and do that consistently, right? So 15% return. I mean, people talk about like the market is efficient, you can't add alpha and all of that stuff, but I don't believe that. I think if you learn to become a better investor, to become a better options trader, to become better with managing capital markets, then you will become better and you will make more money. I've certainly found that to be the case for me, but I've only been doing this option stuff for a little over a year. But I've been doing stocks for over 10 years, and I've learned that I can become a better stock investor if I choose better companies. And over time, I've learned how to do that through looking at the return on invested capital, the uh, margin growth rate over time, and comparing that to different companies. But going back to margin, so I try to keep that, which means I use up a margin leverage rate of about maybe 1.2 to 1.7. Warren Buffett uses 1.6 leverage, but this is kind of the amount of leverage I would use. So in other words, if I had like $100,000 of my own money, I would borrow 20,000. So my total stocks that I would buy is 120,000, if that makes sense, right? So that is what I'm doing with that in terms of the margin. Now, what happens if the stock goes down like 50%? Then I would be getting a margin call if I didn't have a backup plan. So this is what I was saying with having a two-tiered risk system. So this is my first level of safety, is just having margin. I have, uh, I forgot what the numbers are right now, but I think I have like 400,000, around 400,000 of net liquidity if I were to like sell everything and just hold cash. And I have over $500,000 of long stocks. So it's about like 1.4 or 1.5 leverage. Now, if that goes to 2 times leverage, which it almost never does, but when it starts to creep up and it starts to get to 1.7 times, which can happen if the stock market goes down, this is where my secondary fail-safe comes in, and I have $500,000 of borrowing capacity in a couple of home equity lines of credits that I have, which are just loans against my properties, my rental properties and my house. And I can basically take this and take the money from here and plow it back into my margin account to sort of save myself and top up my margin requirement. And I actually had to do that earlier this year. Part of the reason was because my leverage was starting to get high. It was about 1.6. And the other reason is because I think it's a good time to be buying more stocks in the market right now. So earlier this month, I just made a video, right? So if you guys um, haven't seen it already, well, it's on the channel, so you can basically look at that. But earlier this month, I basically took 100K and I threw it into my margin account. So that brought my ratio, my a leverage ratio down back to like 1.3. Now, how this works is if the S&P 500, which today is at, let's go with the index. Okay, so right now it is at, let's say 4,000, right? So I just put in $100,000 this month, so I'm not going to put in more, but if it drops to 3,500, if it drops to this level right here, let me make this line thicker. Okay, if it drops to that level right there, 3,500, I am going to take another $100,000 from my HELOC and then put it into my margin account, because at that time I would probably be running pretty close to the 1.7 or 1.8 times leverage, and I'll be pretty close to getting a margin call. And my excess liquidity, that's also going to drop if the stock market drops to 3,500. Now, if it drops to 3,000, I'm going to take another 100,000, put it into my margin account from my HELOC. And if it drops to 20, so you can see how I can basically do this for 4 more times before I run out of money, before I'm going to get a margin call, right? So, some people might think, well, what if it goes to like 1,500? I mean, I don't have a plan if it goes to 1,500, to be honest, but by then I think I have more important things to worry about. The other thing is we have to remember when markets go down, they don't go down in a straight line. We go like in a zigzag way, right? So it's not like by next week the S&P is going to go to 2,000 points. I mean, maybe like if an asteroid hits the planet or something, but it's just not likely to drop so much in a very short amount of time. So let's say it takes like months or even a year to drop down to 1,500. Well, I have time during that time to figure out a plan to shore up my margin account to make sure I don't sell anything, because that's the worst thing you can do is sell during a market correction. So maybe that means I'll have to like sell a property or two. I don't know, but there's definitely ways around that. So that's sort of a long answer, and I'll probably make a video out of this to show like how you can use a margin account to increase your returns while making sure you don't risk getting into a situation where your brokerage is liquidating your assets, because that's when you get margin called, and that's not good, right? It's because of this. I have this. This is like my um, th- this is what's bankrolling me right now. If I didn't have this HELOC, then uh, it would be very hard to manage a margin. I would have to constantly keep my excess liquidity above like 100,000 or a certain threshold. And of course, the idea is once the stock market goes back up, because the stock market always goes back up to new highs. So eventually, I don't know if it takes like 1 year or 2 years or 5 years, eventually the market will go back up to all-time highs, right? And when that happens, what I'm going to do is sell. Yeah, so if it goes back up to like 4,700 or 5,000, um, whenever it does that, I will simply sell some of my most highly valued, highly valuation stocks at that time. So the stocks that have gone up the most, right? The multiple has been increased the most, and then sell those and pay back my HELOC, right? Because I still have that, like that 500,000 or whatever I borrow from it, 100,000, that debt is not going away unless I pay it back. So when I pay it back is when the stock market goes back up, and then I'm going to sell, slowly shave off the top. Um, oh, Dawn has a Smith maneuver going on. Right. So yeah, that's a really good idea. I know a few people doing the Smith maneuver, which is basically it's a little bit different than this, but it is taking advantage of a home equity line of credit. And then the big benefit of that is you can write off some of the interest payment on your mortgage. But you can definitely, like, once you've built up enough equity in your HELOC, you can basically use this method of what I'm doing here, right? Using margin, and if you want to, or like Don's mentioning, if you just want to do covered calls, that's fine as well. You can use the HELOC money, put it into the brokerage account, and instead of like doing all of this stuff, you can just go with like some covered calls, right? Or some, because this is basically cash. This is liquidity. You can do like cash secured puts, which are put options where you are covered in case you get assigned those stocks. So either strategy will work very well. You can start off making like a 2 or 3% return on your whatever capital you have in there, however much you decide to put in with your HELOC. As I mentioned, like in the beginning of the stream, like with the 4% from dividends, and then there's like a 2% from options if you want to do that. So I would try that out. It never hurts to start off small and see what you can do with it, because the more you learn, the more money you can make and the more opportunities you can find, right? Because the nice thing about investing is you don't have to uh, take risks, like unnecessary risks. You just use the things that already work. It's kind of like this is from Instagram, but it's basically Sun Tzu saying that this is more like when you're going to war, move not unless you see an advantage, right? So don't move your troops to fight unless there's something to be gained. And I think that actually applies to investing as well. You don't have to move. You don't have to take any actions if you don't think there's a good opportunity there to do something. So a critical lesson I've learned with options is it's not that I'm like not a good way to uh, trade options is thinking beforehand what you want to do and then go do it. What's actually better if you want to make the most out of options is looking at patterns in the market, recognizing a high probability trade and then doing that trade, right? So it's about being flexible again, I guess. But like right now, I'm saying the market is probably going to be going down short term. So therefore, the bear call spread is probably a good idea, right? Instead of I'm going to use a bear call spread uh, in the market, even if, maybe now's not the good time for it. BJ is asking, any thoughts on Berkshire's recent add to Ally? I'm not sure. Did they add Ally? I haven't seen that news actually. Um, I know they picked up some more Occidental, some more like oil companies, but what happened here? Was this from like a recent 13F filing? So it looks like they increased their position in Ally Financial and Activision Blizzard and Microsoft. Okay, so those are some pretty safe bets. Activision Blizzard, it's a good long-term hold if you believe in the multimedia, the gaming industry. They're one of the bigger players. Microsoft, you can't go wrong with Microsoft. Uh, Ally, yeah, I mean, it's it's a very like Warren Buffett thing to do, right? Because none of these kind of stand out as like game changers. So yeah, I mean, the biggest risk I think for Berkshire Hathaway is uh, Apple stock. I mean, if Apple misses on a couple of quarters, and if Apple goes down, like Berkshire Hathaway is going down with it, because what is it, like 40% of Berkshire Hathaway is Apple shares, something like that. It's like so concentrated. I mean, if you want to buy a diversified portfolio with Apple, just buy Berkshire Hathaway, right? Because that's got Apple in it. And if you have a lot of Apple and BRK, then you're almost like too concentrated in Apple, I would say. I mean, Apple is the biggest company, so it's definitely, uh, it's not going to lose you a lot of money over time. But if you're thinking about getting higher returns for your money, it's hard for me to see Apple growing at a fast pace, compared to some of the other players in the market. So some of the biggest names that I would be looking at right now, of course, you guys know from my weekly Google options challenge, I like Google. That's one of my highest convictions. I think at 110, they are definitely a good price right now, especially they're only trading at 22 times PE. And it's funny because my put option for last week was at 110 and it ended at 116. So barely made it without getting assigned 200 shares. We'll see what happens next week. So I like Google. I think Amazon is another good play. If you want to buy one tech stock right now, I probably buy Alphabet or Amazon because I think Amazon has a lot of potential with its AWS that is not really priced into the market right now. And then recently I just bought, if you watched this morning's video, I bought 100 shares of Adobe. That is not as good of a stock right now to buy as either Amazon or Alphabet, because for Adobe, we could go down to 360 again or even lower, but I think at around 300. So, unlike some of the other software companies that aren't making a profit, Adobe is making a huge amount of cash flow. And they're trading at about 27 times cash flow right now and like 25 times forward PE, but they're growing really fast at like 14% a year. So I think the lowest, if we hit a recession and the S&P falls another 20%, I think the lowest Adobe might go is like $300. So if you want to wait, you could have a chance to pick up Adobe at somewhere between like 360 to 300. But I wanted to just get in a little bit early, partly because my option expired in the money and I got assigned. And I wanted to get assigned instead of closing it. But the thing is, like if we look at like 5 years out, it doesn't really matter too much if you're buying it at 381 or 360 or 350 or even 300, because if it goes back up to 600, 700, that's a lot of profit anyway. So I'm buying Adobe now, knowing that it could be lower. I'm not trying to catch the bottom. I'm trying to buy it at a reasonable price that over the next 5 years will look like a cheap price. And I think now is a good time to start doing that. As always, I don't recommend you go all in or enter a full position. If you want to buy any stock out there, I think the best way to do that is to dollar cost average in, because then you're spreading out your um, price risk across time. You're not concentrated on like a single price point, right? Because if you buy a lot now and it drops later and you don't have any more money to buy, or you can't afford to add more of it in your portfolio because it'll be too concentrated, then you're kind of out of luck. But if you buy a little bit now, let's say you split it up into 3 or 4 times and it goes down, you can average down. And if it goes up, you've made a profit. You can still average up. And averaging up is actually more safe because a stock that is rising will likely continue to rise. Whereas right now it looks like Adobe is falling long term, it is more likely to continue to fall. So that's just something to keep in mind. And yeah, so let's take a look at how many people are still here. Well, it's about the same. Uh, Cool. All right, so I think that's pretty much going to cover it for today. It's been an hour and a half. You guys asked some really good questions. Thank you all for coming. Yeah, we'll probably have to do this again maybe sometime closer to the end of the year. I'm thinking maybe in the like November or December, because I'll have one of these every season or so. Like this one is for fall. Last time I think it was like spring or summer. So yeah, thanks a lot for coming. And I will post this video up shortly for those who can't make it. Enjoy the rest of your evening, and I'll talk to you guys in the next one. Bye for now.